So, if you looked at Aeon Credit's financial health just, 6 months ago, you would have reasonably concluded that the company was straight up drowning.
Oh, absolutely. I mean, the
Yeah.
optics were terrible.
Right? Profits were in free fall. The whole macroeconomic environment was just, well, hostile. And bad loans were piling up way faster than anyone anticipated.
Faster than the market could price in, yeah.
Exactly. But if you looked at the stock ticker right at the opening bell today being April 8th, 2026, you just saw a vertical green line that completely shatters that old narrative.
It really does. Gapping up like that is a massive statement.
Yeah, Aeon Credit didn't just survive this localized crisis. They basically pulled off one of the most aggressive corporate pivots of the year. The stock gapped up from RM 5.36 to close at a very lively RM 5.67.
Which forces a total recalibration of, how you view their entire business model. When a stock chart draws a sudden vertical line like that, it isn't retail height.
No, not at all.
Right. It means institutional capital fundamentally misunderstood the company's resilience. And the raw data just arrived to correct the public record.
And that data correction is exactly what we are dissecting today. So this deep dive is actually a highly requested follow-up for you, the listener, especially if you tuned into our Q1 FY2026 analysis.
The gloomy one.
The very gloomy one. That's the one on our YouTube channel under the reference UQD Sembigo MVE38C. Back then, the outlook was incredibly grim. I mean, net profit had plunged almost 27%.
Yeah, we spent that whole deep dive talking about rising risks, bleeding margins, and a digital bank venture that looked like an anchor.
Literally dragging the ship down.
Mm-hmm.
But today, we have their freshly released Q4 FY2026 financial report. We've got updated dividend schedules, breaking coverage from the edge, and a whole flurry of analyst reports.
A lot of material to get through.
For sure. Our mission today is to figure out the mechanics of this turnaround. Like, how does a company go from fundamentally stressed to beating earnings estimates and throwing out special dividends in just a matter of quarters?
Well, to understand the cure, you first have to properly diagnose the disease they were fighting back in Q1.
Right.
The narrative back then was that inflation was just crushing the consumer. Aeon Credit's core customer base, basically those working class and middle income demographics, the B40 and M40 groups, they were buckling under the rising cost of living.
Which makes sense. I mean, groceries go up, rent goes up.
Exactly. And the assumption was that these consumers would stop taking out loans, or worse, default en masse on the ones they already had.
Which theoretically would just stall the company's revenue engine completely. But looking at these Q4 numbers, the top line didn't stall at all. The data is actually pretty staggering.
Let's hear it.
So for the fourth quarter ending February 28, 2026, Aeon Credit posted a net profit of RM 1144.3 million.
Wow.
Yeah, that is their highest quarterly profit since the first quarter of FY 2023. And it wasn't just like a flash in the pan to end the year. It dragged the entire full-year net profit up by 4.1% to RM 385.88 million.
But the real story, I think, is hidden in the revenue generation.
Right, the top line.
Yeah, which jumped 12.3% for the full year to RM 2.47 billion. And this wasn't just a minor incremental beat. The reporting in the Eds today highlights that these results beat consensus analyst forecasts by a massive 12%.
Beating the street by 12% during high inflation is wild.
It is. When a consumer finance company does that, you really have to look at the psychology of their specific loan portfolio.
And I want to explore that psychology because I think it explains the mechanism behind that 12.3% revenue jump.
Yeah, let's break it down.
So a massive chunk of Aeon Credit's business is vehicle financing, specifically motorcycles and used cars. Now, when inflation hits, a consumer will absolutely cut back on discretionary spending, right?
Or they stop eating out, delay buying a new TV.
Exactly. But if you are, say, a gig economy worker or you live in an area without reliable public transit, your motorcycle or your car is your livelihood. It is the literal tool you use to generate your own income.
It's non-negotiable.
Right. Therefore, that vehicle loan becomes the stickiest debt you have. It is the absolute last bill you stop paying before you go under.
And that right there is the critical nuance the market missed 6 months ago. Analysts looked at the macroeconomic pressure on the B40 and M40 demographics and just assumed a blanket collapse in spending.
They painted with too broad a brush.
Exactly. They failed to categorize the type of spending Aeon Credit actually finances. The demand for mobility doesn't just disappear during a mild economic downturn, it just shifts.
So instead of buying a brand new car, A consumer might finance a used car or a motorcycle through Aeon.
Yes, the top-line engine was never actually broken. People still needed the financing, and Aeon was still collecting the interest and financing charges.
Okay, so if the revenue engine was humming along at a double-digit growth rate the entire time, that 27% profit plunge we saw back in Q1 had to be entirely a bottom-line issue.
Oh, 100%.
Like the money was coming in the front door, but it was just pouring out the back door just as fast.
A leaky bucket?
Right. It's like they were running a marathon, wearing a 50-pound weighted vest made entirely of bad debts. Looking at this Q4 data, it's not that their top speed suddenly increased or they magically found a massive new pool of customers. It's that they finally unbuckled the vest.
The financial reports validate that visual perfectly. The vest in this scenario is their impairment provisions.
Right, the money they have to legally set aside for bad loans.
Exactly. In the third quarter of this year, their total operating expenses, which are heavily burdened by those impairment provisions, sat at a massive RM 407.1 million.
Ouch.
But by the fourth quarter, that number plummeted to RM 325.9 million.
Wait, that's a drop of nearly 20% in total expenses in a single quarter.
Yep.
That is the kind of aggressive cost curve bending that turns a mediocre year into a record-breaking one. But this leads to a vital question for you, the listener. If you were trying to understand banking operations, how does the company actually orchestrate that?
Because you can't just wave a magic wand and make bad customers suddenly pay their bills.
Exactly. So how did they fix it?
Well, you can't change the past, but you can aggressively filter the future. And that requires a two-pronged approach. First, management initiated severe remedial actions on credit approvals.
Tightening the belt.
Yeah, they tweaked their internal scoring models. So if a borrower profile historically had, say, a 5% chance of default, maybe they still got approved last year. This year, Aeon raised the threshold.
So demanding higher credit scores, larger down payments, that sort of thing.
Exactly. Or just rejecting marginal applications altogether.
But the danger there is, if you tighten the credit tap too much, your sales funnel dries up. It's that classic banking trade-off. You can have rapid loan growth, or you can have pristine asset quality. Trying to achieve both usually results in neither.
Which is exactly what makes that 12.3% revenue growth so impressive.
Right, they pulled off both.
They managed to find enough high-quality borrowers to keep the portfolio expanding while simultaneously cutting off the risky ones. But the second prong of this turnaround is something CIMB Securities highlighted in a very perceptive research note today.
Oh, I read that one, the seasoning phase.
Yes. They pointed out that Aeon's legacy credit risks are finally entering their final seasoning phase.
I found that concept so fascinating. Because seasoning phase sounds like something you do to a cast iron skillet.
It really does.
But in consumer lending, it is a profoundly important concept. It essentially means that time is the ultimate risk management tool.
It's a universal lesson in finance, honestly. A bad loan portfolio doesn't necessarily need an active fix. Sometimes it just needs to be survived.
Survived, right.
When a company writes a batch of suboptimal loans, the defaults don't just happen evenly over 5 years. They tend to cluster early on, usually in the first 12 to 18 months.
So if a borrower is going to stop paying, they usually do it early.
Right.
So this seasoning is just the brutal process of letting those early defaults wash through the system. You take the write-offs, you suffer the heavy impairment provisions, which is exactly what we saw in Q1, and you just wait.
You weather the storm.
And once that 18-month window closes, the borrowers who are left are the ones who have proven they can and will pay, even under inflationary pressure. The portfolio is now seasoned.
Precisely. The bad debt has been flushed, and the remaining loans are highly stable, reliable revenue generators.
So that is the turning point Aeon Credit just crossed.
Yes. The bucket stopped leaking because the weakest loans finally seasoned out of the active portfolio, and the new loans coming in were underwritten with much stricter standards.
So all of that strong double-digit revenue growth was suddenly allowed to just flow freely down to the bottom line.
Which resulted in that RM 144.3 million quarterly profit.
Man, it is a brilliant display of chronological endurance by the management team.
It really is.
But as much as the core business seems to be totally revitalized, we cannot ignore the digital elephant in the room.
Ah, yes. Aeon Bank.
Right. If we look back at our Q1 analysis, the core lending business wasn't the only thing dragging down profits. We spent a lot of time dissecting their digital bank venture. This is the cornerstone of their ambitious Living Zone ecosystem, where they want to seamlessly integrate Aeon retail shoppers with Aeon Financial Products.
A huge undertaking.
Given how aggressively they've cleaned up their traditional lending, I have to assume the digital bank is finally starting to pull its weight.
Well, if you are looking for a flawless earnings report, this is where the narrative hits a speed bump.
Oh no.
Yeah. Building a digital banking infrastructure from the ground up is a notoriously capital-intensive endeavor. You aren't just building an app, you are building a heavily regulated financial core, investing in massive cybersecurity, and spending aggressively to acquire customers.
So they're still burning cash.
Heavily. The Q4 report reveals that Aeon Bank is still very much in its cash-burning phase. In fact, Aeon Credit's share of losses from the digital bank actually widened to RM 74.1 million for the full FY 2026 year.
RM 74.1 million in losses. Wow. Just to anchor that for you, the listener, the loss in the previous year, FY 2025, was RM 68.3 million.
So the bleeding there has intensified.
The digital bank is getting more expensive to run, not less.
It is, and their commitment to this strategy is only deepening. Hidden in the details of the Q4 report is a very telling transaction.
What did they do?
In January 2026, so just weeks before the financial year closed, Aeon Credit completed a subscription for an additional 125 million ordinary shares in Aeon Bank.
Wait, they injected another RM 125 million in hard cash.
Yep, just to maintain their 50% equity stake in the venture alongside their parent company.
Dumping RM 125 million into a venture that just lost you RM 74 million over the last 12 months is a massive doubling down kind of bet.
It takes nerves of steel.
It really does. But the unit economics of digital banks are brutal in the early years. You have to offer promotional interest rates to lure deposits away from traditional banks, and you have to offer fee-free transactions to keep users engaged on the platform.
It's a classic technology play. Subsidize the user base now, achieve scale, and figure out profitability later.
But it feels like a paradox, doesn't it? Celebrating a corporate turnaround while they are actively feeding a 100 million ringgit money pit.
It looks like a paradox until you view it through the lens of capital allocation. What management is executing right now is a highly sophisticated balancing act.
Okay, how so?
Back in Q1, when the core vehicle financing and credit card business was struggling under the weight of bad debts, the digital bank losses felt like an anchor pulling the entire enterprise underwater.
Right, because everything was sinking.
But today, the core business has been fundamentally repaired. It is generating so much free cash flow that it can effortlessly subsidize this expensive long-term digital strategy.
Ah, I see. They're funding their future moat with today's profits.
Exactly.
The digital bank is no longer an anchor. It's just a heavy backpack that the core business is now strong enough to carry up the mountain.
That's a great way to put it.
And if management is confident enough in their cash flow to carry a 100 million ringgit backpack, that confidence usually bleeds into how they treat their shareholders. Did that translate to the dividend announcement?
It translated remarkably well, and honestly, it served as the primary catalyst for today's market surge. Alongside the earnings beat, Aeon Credit declared a final dividend of 15.75 cents per share.
Which is solid.
But the true signal to the market was the addition of a surprise special dividend of 2 cents per share.
Wow. A special dividend is the ultimate corporate flex.
It really is.
You don't hand out unprompted cash to shareholders if your internal projections for the next quarter are showing weakness. It is management effectively saying the turnaround is complete, the cash is real, and we have more than we need.
Absolutely. Both of those dividends are payable on July 23rd, which brings the total payout for FY 2026 to 30.75 cents per share.
That is a highly visible step up from the 28.75 cents they paid out in FY 2025.
And it directly rewards the investors who understood the seasoning phase and held on through the volatility of the past 6 months. And the analyst community has clearly capitulated to this new reality as well.
Oh, yeah. What are the analysts saying now?
Well, based on Bloomberg terminal data referenced in today's coverage, all 5 research houses covering Aeon Credit now maintain unanimous buy calls.
Unanimous agreement among 5 different research desks is incredibly rare.
Right.
Analysts are naturally defensive creatures. Somebody usually wants to maintain a hold rating just to hedge their bets.
It speaks to the undeniable clarity of the Q4 numbers. Furthermore, their average target price is now sitting at RM 6.70.
RM 6.7. So even factoring in today's aggressive gap up to RM 5.67, The institutional consensus implies there is still significant upside potential waiting to be realized.
There's definitely room to run.
Which brings us to a critical juncture for you, the listener, as we synthesize all of this data. It is time to officially update the show's financial Moat scorecard for Aeon Credit.
Drum roll, please.
During our Q1 analysis, I issued a very cautious score of 6 out of 10. The revenue growth kept them in the game, but the deteriorating asset quality, the soaring impairment losses, and the unchecked cash burn of the digital bank raised serious questions about the durability of their competitive advantage.
It was a fair assessment at the time.
But after dissecting this report, considering the rigorous expense control, the successful seasoning of their legacy loans, and their ability to hike dividends while funding a massive digital expansion, I am officially raising Aeon Credit's Moat score to a solid 7 out of 10.
I fully endorse that upgrade, because the criteria for a strong financial moat isn't just profitability in a bull market.
No, anyone can make money in a bull market.
Right. A true moat is defined by how a business absorbs and deflects macroeconomic damage. Aeon Credit just successfully navigated a severe inflationary storm that directly targeted their most vulnerable customers.
They managed to thread the needle.
They did, growing their loan book by 12% while simultaneously tightening credit standards and flushing out bad actors. That demonstrates immense brand strength and pricing power within their specific market niche.
They stabilized their defenses and proved the core model is highly resilient.
Without a doubt.
So to summarize this rather incredible corporate journey, over the last 6 months, we watched Aeon Credit transition from a heavily provisioned, deeply concerning Q1 into a masterclass of operational discipline in Q4.
A total 180.
Yeah, they recognized the leaky bucket of operating expenses, they let the calendar do the heavy lifting as legacy bad loans seasoned out of the portfolio, and they rewarded the patience of the market with a stock gap up and a special dividend.
And perhaps the most impressive feat of all is that they engineered this entire financial renaissance while seamlessly absorbing the RM74 million impact of their ambitious digital bank venture.
It really is a textbook example of strong executive management stepping in to correct a localized credit crisis, entirely without abandoning their 10-year strategic vision for the digital living zone.
A tough balance to strike, but they pulled it off.
But I want to leave you with a final, slightly provocative thought to mull over as you evaluate Aeon Credit's place in your own mental portfolio.
Let's hear it.
We've just spent this entire deep dive analyzing how they posted their highest quarterly profit in years, right? But remember the context. They achieved those record-breaking numbers while carrying the weight of a digital bank that is losing RM74 million a year.
Right, that backpack is still heavy.
So the multi-million ringgit question becomes, what happens to their bottom line, their dividend capacity, and their stock price if Aeon Bank actually finishes its investment phase, stops burning cash, and becomes profitable?
Oh, man. If that transition occurs and that digital anchor genuinely transforms into an additional growth engine, the compounding effect on their consolidated earnings will fundamentally alter the valuation of the entire company.
It is a fascinating horizon to keep an eye on. Well, if you found yourself rethinking how bad debt works today, or if this deep dive helped clarify the mechanics behind today's massive stock move, please take a second to like the video and subscribe so you don't miss our next financial breakdown.
We really appreciate the support.
We do. We really want to hear from you in the comments. Are you buying into the long-term vision of Aeon's digital living zone, or do you still view that digital bank as an unnecessary risk to an otherwise brilliant core business? Drop your thoughts below. Thank you so much for joining us on this journey from the gloomy Q1 to today's breakout, and until next time, keep looking beyond the numbers.